So the dollar amount reported on the balance sheet for assets attempts to measure the asset's expected future service potential to the company. Now let's think about what that could mean. So let's assume that I own a restaurant. And so here's one of my chairs for my restaurant. How would I measure the expected future service potential of this chair to my restaurant? Well, I'd want to think about, how do I actually use this chair? How do I generate value? How do I generate value for my company from this chair? And the answer is by having customers sit down in this chair, order food from my restaurant, and pay me for it. So if I want to think about how I generate value from this chair and measure that expected future service potential, I would need to figure out how many customers will sit in this chair, over what period of time, how much food will they buy from me, how much will they pay me. And then I have to figure out, because it's over time, it might be 2, 3, 4 years, however long this chair lasts, I'd have to factor out the time value of money, essentially factor out interest to figure out the value today of the expected future service potential. Now, that's a challenging task, but it becomes even more difficult because there also is a table, there's cutlery, there's plates, there's glasses, and so forth. What they spend would have to be allocated across all those different items. Now, if you were an accountant and came up with an estimate for this chair, based upon all the cash it would help bring in, would you want to go into court and defend that in a court of law? I doubt it. Accountants don't want to. So that's not the way we measure expected future service potential, even though it's the ideal measure. So we have to come up with ways that are easier and more defensible in a court of law, because we're putting our reputation behind the dollar amount attached to this chair. So one option, which we'd use in this case, is the cost of the chair. So if I had paid $50 for this chair would go on my balance sheet at $50. That's a cost-based asset. What cost is necessary to place the chair in service? That's one alternative, and that's what we would use for a chair. Other types of assets, so if I bought shares in ANZ Bank, in that case, those shares trade on the market, and I could use the fair value of the shares as a measure of the expected future service potential. So I could look up their value at the close of the day, and if they're selling for $10 a share, that's the value I attach to it on my balance sheet. So different ways to measure expected future service potential. None of them are ideal, but they're the best accountants can do, because the ideal situation is just too difficult, too complex to actually use. So we've said that the balance sheet reports the cumulative financial effects of all the operating, investing, and finance activities since the company's been in business. So let's look at the balance sheet and identify which line items trace back to operating, investing, and financing activities. So you'll notice from the balance sheet here that different line items are highlighted. So notice that other current assets and other current liabilities, those are associated with operating activities. So if we go back to our picture of what the company does, that relates to interactions with the customers and the suppliers. So current assets, current liabilities, that's where you're going to find out about the cumulative financial effects of operating activities. The investing activities are associated with non-current assets. So those will tell you about assets held as investments. And if we refer back to the picture of what companies do, and additionally, long-term assets used in operations. Both of those will be on the balance sheet as part of non-current assets. Now, what about the financing activities? As you can see from the balance sheet, loans, both current and non-current, would be part of financing activities dealing with the debt holders, as well as contributed capital. That tells you about interactions with the shareholders. And you can also see that cash and cash equivalents, they tell you about operating, investing, and financing activities, all of the cash flows during the year. And earned capital also tells you about operating, investing, and financing activities. The difference between the cash and the earned capital is one tells you about cash, one tells you about wealth.